First, welcome to the video. Today we will walk through a clear, math-first decision framework for choosing between holding an underwater stock and paying off an 8% line of credit. We will focus on guaranteed returns versus speculative outcomes, explain the sunk cost fallacy, and show visuals and examples. By the end, you will be able to make a rational decision and implement a step-by-step plan. Let us begin. Next, here is our agenda. We will start by defining the scenario, then compare a guaranteed 8% return from paying off debt with the speculative return from holding an underwater stock. After that, we will cover the sunk cost fallacy, walk through a decision flowchart, and look at key numbers. Then, we will present an action plan and diversification blueprint, followed by a couple of quick quizzes and a wrap-up. Before we proceed, here is a brief disclaimer. This content is educational and not individual financial, tax, or legal advice. You should consult a qualified professional about your specific situation. Additionally, rules, interest terms, and tax treatment can vary by jurisdiction. Use this material as a framework, then tailor it with professional guidance. Now, let us set up the scenario. You have a $40,000 line of credit with an interest rate above 8%. You also have $40,000 in a single stock position that has lost significant value. You can liquidate the stock to pay off the debt, or you can keep the stock and continue paying the 8% interest. We will analyze which choice is financially optimal. Moving on, let us compare a guaranteed return with speculation. When you pay off an 8% debt, you lock in a risk-free, guaranteed 8% return on your money. That is because eliminating the interest expense is equivalent to earning that rate without risk. To justify holding the underwater stock instead, you would need to be confident that the stock will outperform 8% annually starting right now, with near certainty. That is a very aggressive assumption, especially for a single stock that has already declined significantly. Moreover, time works against you, because each month that passes with the debt outstanding incurs more interest cost. Continuing, this flowchart illustrates the two choices. Starting with the situation of an underwater stock and 8% debt, one branch is to hold the stock. That path leads to continued interest expense at 8% per year, and the requirement that the stock outperform that rate to break even after considering risk, taxes, and timing. It also emphasizes the uncertainty and possibility of further decline. The alternative branch is to sell the stock and pay down the debt. That leads to immediate elimination of interest charges, effectively capturing a guaranteed 8% savings. The final node encourages rebuilding a portfolio with broad diversification. The diagram highlights that the guaranteed savings generally dominate speculative recovery in a single stock. Furthermore, we must address the sunk cost fallacy. Your original purchase price is no longer relevant. It is a sunk cost and should not influence the decision going forward. Instead, reframe the question. If you had $40,000 in cash today, would you choose to buy more of this underperforming stock, or would you use the cash to eliminate an 8% liability? The rational choice is almost always to pay off the debt. Additionally, if you realize a capital loss, you may be able to use it to offset future capital gains depending on your jurisdiction. Consult a tax professional to confirm specifics. Next, this pie chart quantifies the annual stakes on $40,000. At 8% interest, the annual cost is $3,200. For the stock to simply break even against that cost, it must generate at least $3,200 of return within the year. Only returns above that level begin to outperform debt repayment, and that ignores taxes, volatility, and risk. This visualization makes clear how high the hurdle is. Meanwhile, here is a simple break-even table for a $40,000 position. If the stock returns 5% in 1 year, that is $2,000, which is still short of the $3,200 in interest cost at 8%, resulting in a negative $1,200 gap compared to paying off debt. If the stock returns 8%, that is $3,200, which merely ties the interest cost, but it involves market risk and taxes. If the stock returns 12%, that would be $4,800, which finally beats the interest cost by $1,600. However, that outcome is speculative and uncertain, especially for an already underwater, concentrated single stock. Now let us move to execution. First, audit your balances and confirm the exact annual percentage rate, compounding method, and payment schedule of your line of credit. Second, place the appropriate sell orders to liquidate the single stock position. Third, immediately apply the proceeds to the line of credit to halt further interest accrual. Fourth, record the realized loss for your tax records and potential offset of future gains. Fifth, rebuild using a diversified core, such as low-cost broad market index funds or exchange-traded funds. Sixth, automate contributions on a schedule to dollar cost average and reduce timing risk. Seventh, write down an investment policy statement specifying diversification rules and position size limits to prevent future concentration risk. Additionally, this mind map presents a diversification blueprint. The central concept is a diversified portfolio. One branch is core index funds that include a United States total market fund, an international fund, and a bond allocation. Another branch covers risk management with position sizing rules, a periodic rebalance schedule, and an emergency fund. A third branch emphasizes costs, including expense ratios, taxes, and turnover. A fourth branch addresses behavior by maintaining discipline, adhering to the investment policy statement, and avoiding single stock concentration. A final branch addresses time horizon, keeping short-term needs in cash or very low-risk vehicles, and allocating long-term growth to equities. In contrast, here is a side-by-side comparison. Holding the underwater stock means continuing to pay 8% interest, requiring the asset to beat that hurdle rate after taxes and risk while carrying single stock volatility. It also invites emotional anchoring to the original purchase price. Liquidating and paying the debt immediately captures a risk-free 8% savings, stops the ongoing interest drain, simplifies your financial picture, and opens a clear path to rebuild with diversified positions. Now for a quick check. The question is, which choice delivers a guaranteed, risk-free 8% return in this scenario? Option A, holding the underwater stock until it recovers. Option B, paying off the 8% line of credit. Option C, buying more of the same stock to average down. Option D, waiting for the market to rebound before deciding. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B, paying off the 8% line of credit. Eliminating an 8% liability locks in the equivalent of a risk-free 8% return by removing the guaranteed interest expense. Next, here is the second question. Which statement best describes the sunk cost fallacy? Option A, past losses should guide future choices to avoid regret. Option B, the original purchase price is irrelevant to current decisions. Option C, averaging down always reduces risk. Option D, waiting guarantees eventual recovery. You may pause the video now to consider your answer. We will discuss the answer in the next section of the video. The correct answer is B. The sunk cost fallacy occurs when past expenditures or losses influence current decisions. Rational decisions should be based on present information and future expectations, not on historical purchase prices that cannot be changed. Additionally, here is a concise three-part playbook. First, eliminate high-interest debt before anything else. Second, codify diversification rules to prevent single stock concentration in the future. Third, build a simple core using a total market fund, an international fund, and a bond allocation. The accompanying mini flowchart reiterates this sequence, from assessing the debt to liquidating underwater positions, paying down the line of credit, and automatically rebuilding a diversified portfolio. To summarize the main ideas, first, paying off an 8% debt is equivalent to earning a risk-free 8% return. Second, waiting for a single stock to recover is speculation and not a robust plan. Third, do not anchor decisions to your original purchase price, since it is a sunk cost. Fourth, the optimal sequence is to cut losses, eliminate the interest burden, and then diversify. Finally, here is the verdict. Liquidate the underwater stock and use the proceeds to pay off the 8% line of credit immediately. Document and use any realized losses according to your jurisdiction's tax rules. Then, rebuild with diversified, low-cost funds and a written investment policy statement that prevents future concentration risk. Taking decisive action now locks in guaranteed savings and restores financial control. As a creative closing, if you found this walkthrough helpful, please like the video, share it with someone who might be wrestling with a similar decision, and subscribe for more practical Math First Money content. Comment below with your plan of action and any questions you would like us to cover next.